For the better part of the last 2 years, the Vancouver housing market has been stuck in what I call a waiting game. Buyers have been waiting for prices to fall further. Sellers have been waiting for interest rates to come down. Investors have been waiting for the perfect opportunity to jump back in. And every month, it seems like the headlines tell a completely different story. One day you'll hear the housing market is crashing, and the next day you'll read that the recovery has already started. It's gotten to the point where a lot of people simply don't know what to believe anymore. But every once in a while, a market report comes out that tells a much bigger story than the headlines do. And in my opinion, the June 2026 Greater Vancouver Housing Report is one of those reports. For the first time in quite a while, several key indicators all are beginning to move in the same direction. Home sales are climbing, and inventory has stopped growing. New listings have actually declined for once, and buyer activity is increasing across detached homes, townhomes, and even condos. Yet prices are still lower than they were a year ago. And that's an interesting combination because historically, that's exactly how housing markets begin to stabilize before prices eventually respond. Now, before anyone starts celebrating and saying Vancouver is back, let's pump the brakes for a second. That's not what I'm saying. We're nowhere near the frenzy we saw in 2021 and 2022, and affordability remains one of the biggest challenges anywhere in Canada. Interest rates are still much higher than they were a few years ago, and buyers are still being careful with their money. But markets don't announce when they hit the bottom. They don't just send out a notification saying, congratulations, today is the cheapest you'll ever buy. Instead, they quietly begin changing underneath the surface while most people are still focused on yesterday's news. And that's why today's report matters so much. So today we're going to break down exactly what happened in Vancouver during June and what the numbers actually mean and why I think some people are completely misreading this market and whether this is the beginning of the next housing cycle or simply another temporary bounce before prices fall further. One thing I've learned after following real estate markets for years is that headlines almost always arrive late. The media reports what's already happened, essentially looking through the rear view mirror. Meanwhile, savvy investors and seasoned professionals are looking out the front windshield, trying to figure out what's going to happen next. Every month, you'll see that articles are saying prices are down and prices are up, sales are weak, inventory is high, or buyers are returning. While those statements may be technically true, none of them by themselves tell you where the market is actually heading. Housing markets are a lot like turning a massive cruise ship. They don't spin around overnight. The rudder turns long before the bow shifts. The market begins changing direction gradually, and if you are only watching one lagging statistic, you're probably going to miss the bigger picture. And that's why I rarely focus on benchmark prices first. Prices are the ultimate lagging indicator, and one of the very last things to change because they rely on closed deals from the weeks or months prior. Instead, I pay attention to buyer demand, listing activity, total inventory, and something called the sales to active listings ratio. These are true leading indicators. They measure real-time market velocity and shifts in leverage, meaning they often begin changing months before prices reflect the shift. When you track the ratio of sales to available homes, you actually see the tension building or releasing in the market. A sudden surge in new listings alongside flat sales signals a looming inventory pileup, which inevitably pressures prices downward down the road. Conversely, a quiet uptick in pending sales while inventory stays flat means buyers are chipping away at supply, setting the stage for future price growth. And when I looked through this June report, that's exactly what stood out to me. If you only looked at the benchmark prices, you'd probably think this market is still stuck in the mud. But once you start looking deeper at the underlying absorption rates and the momentum of new supply, the data tells a completely different story, one that I don't think people are paying enough attention to. Let's start with the biggest headline from the report. Greater Vancouver recorded 2,390 residential sales during June. That's a 9.6% increase compared to June of last year. Now, by itself, that number doesn't necessarily mean we're entering another frantic housing boom. In fact, sales are still roughly 12% below the 10-year seasonal average. So we're still operating below what would be considered a normal, healthy, bustling market. Context matters. And we are coming out of a prolonged period of high interest rates that sidelined a massive portion of the population. But that baseline is actually what makes these numbers so encouraging. When markets recover from a downturn, demand doesn't suddenly explode overnight. And buyers don't all wake up on the same morning and collectively decide today's the day they're going to buy a house. Instead, confidence builds slowly, almost imperceptibly at first. It starts with a slight uptick in traffic at weekend open houses. Then listing agents notice they're receiving 2 or 3 offers on a property instead of none. Homes start selling a little faster and days on market metrics begin to shrink. Eventually, the fence sitters take notice. Fear of missing out starts to replace the fear of overpaying, and more buyers begin realizing they may have waited too long to make their move. That's exactly the type of physiological shift in behavior these June numbers are starting to suggest. The market is waking up. Even more interesting is that this momentum wasn't limited to just one specific segment of the market. Detached homes saw higher sales volumes. Townhomes posted stronger activity. Apartment sales also improved compared to last year. That synchronized lift is significant because it suggests confidence is broadening across the entire real estate ecosystem instead of being concentrated to just one price category or property type. In unbalanced markets, you often see activity spike only in entry-level condos as buyers chase affordability, while the luxury detached markets sits entirely frozen. And when that happens, the market is fragile. Historically, broad participation across all product types is a much healthier indicator. It shows that the move-up buyers are active, and folks selling condos to buy a townhome or moving from a townhome into a detached home. And this creates a functional chain of reaction of supply and demand throughout the entire system. It means equity is moving, liquidity is returning to all price points, and buyers at every level are feeling comfortable taking on debt again. And that broad-based strength is our first major clue that something foundational may be changing beneath the surface of the Vancouver market. Over the past couple of years, the primary reasons prices have struggled to find traction is that supply continued to build much faster than buyers are purchasing homes. Think about basic economics. If more homes keep hitting the market than buyers are willing or able to absorb, the pool of available choices expands. Sellers eventually have to compete harder against one another just to get noticed. In the real world, that competition translates directly into longer days on market, frequent price reductions, and ultimately downward pressure on closing prices. That has essentially been the dominant narrative defining our market throughout much of the past 2 years. But June just threw a serious wrench into that trend. New listings were down roughly 6% compared to the same month last year. Instead of more homes flooding onto the market and overwhelming the systems, fewer sellers decided to list their properties. At the same time, total active listings also edged lower than where they were a year ago, down about 3.1%. That might sound like a minor math adjustment, but the subtle directional shifts are exactly what real estate professionals watch like hawks. For months, inventory was accumulating like water behind a dam, and June's data suggests the water level has not only stopped rising, but the reservoir is actually beginning to drain. If buyer demand continues to steadily scale up, as those higher sales numbers suggest, while fewer new homes enter the market to replace what is sold, the available inventory naturally begins tightening. This kind of contraction isn't going to recreate a frantic landscape of blind bidding wars overnight. There's still plenty of standing inventory left to work through before they see that happen again. However, it is more than enough to slowly alter the physiological dynamic of negotiations. It quietly shifts leverage away from buyers who've enjoyed a prolonged period of extreme patience and steep discounts and hands it back towards the sellers. It means lowball offers will start getting rejected straight up, and sellers will feel a little bit more comfortable holding their ground on their list price. That's why I think this inventory story is a massive undercurrent, and it is a much bigger deal than most mainstream headlines are making it out to be. Now let's talk about the statistic that gets all the attention every single month: prices. If you stopped reading the report after looking at benchmark prices, you'd probably come away with thinking this market isn't in great shape. The overall benchmark prices across Metro Vancouver sits at just under 1.1 million, which is roughly 6% lower than it was this time last year. Detached homes have fallen by around 7%, apartments 7%, townhomes 5% over the past 12 months. First glance, those numbers seem pretty negative. If prices are still falling, doesn't that mean the market is getting weaker? Not necessarily. One of the biggest mistakes people make assuming prices are the first thing that changes in a housing market, they're actually one of the last things to respond. And think about it this way. If buyers suddenly start becoming more active tomorrow, sellers don't immediately raise their asking prices by $50,000 or $100,000. Instead, homes simply begin selling a little faster. Fewer sellers reduce their prices. Negotiations become slightly more balanced. Over time, that increased competition slowly works its way into prices. It usually takes several months before benchmark prices reflect what is already happening underneath the surface. This lag occurs because the benchmark index relies on completed closed sales. Deals that were negotiated in lawyers' offices and back rooms 30, 60, 90 days prior. It is an echo of the past, not a broadcast of the present. And that's why I think so many people are focused on the wrong number. Yes, prices are still down compared to a year ago, but the pace of those declines has slowed considerably. Look closely at the month-over-month movements. The composite benchmark didn't tank in June. It essentially flatlined, slipping by a microscopic 0.1%. Detached homes eased by 0.3%, while townhomes edged down a mere 0.2% from May. These micro movements mean the bleeding has stopped. When monthly declines shrink to fractions of a percent while sales are still climbing, that is the textbook definition of market finding its floor and beginning to stabilize. Could prices still scrape along the bottom or even dip a fraction more in the short term? For sure. There's still a healthy amount of total inventory for buyers to sort through, which acts as a temporary ceiling on price growth. But if demand continues improving while new inventory tightens, history tells us that prices generally aren't far behind. The floor establishes itself first, and once the excess supply is absorbed, an upward trajectory begins. If there's one statistic experienced realtors, investors, and economists pay attention to every single month, it's not benchmark prices. It's something called the sales to active listings ratio. Now, I know this doesn't sound very exciting, but stay with me because that one number tells you more about where the market is heading than almost anything else does. It strips away the noise and the hype to give you the reading of market velocity. The sales to active listings ratio compares how many homes are selling relative to how many homes are currently available for sale. In other words, it measures the exact balance between supply and demand. It calculates absorption rate, showing you precisely how quickly the current pool of homes is being bought up in a single area. Right now, Greater Vancouver's ratio sits at approximately 14.6%. And why is that important? Historically, analysts have established clear thresholds for this metric. When this ratio falls below about 12% and stays there for a sustained period, buyers have significantly more negotiating power. Inventory begins building, homes sit on the market longer, sellers start competing against each other, and prices generally experience a downward pressure. On the other hand, once that ratio climbs above 20% and sustains that momentum for a few months, the opposite starts to happen. Inventory becomes tighter, buyers begin competing against one another in multiple offer situations, and prices generally begin to move higher. At roughly 14.6, Vancouver is sitting right in the sweet spot, right in the middle. That tells us something important. This isn't a buyer's market anymore, but it's not a seller's market either. It's becoming more balanced. The frantic, lopsided landscape we saw during the peak interest rate hikes has dissipated, giving way to a much more functional ecosystem here in Vancouver. Now, here's why I think this matters. Real estate metrics do not exist in a vacuum. They represent a delicate equilibrium. Just a modest increase in sales over the next few months, combined with a slightly fewer listings coming to market, could easily add 4 or 5% points to this metric. That seemingly small shift would push the ratio much closer to that 20% threshold, firmly entering a seller's market. And that's exactly why I think the second half of 2026 is going to be incredibly important to watch. The market doesn't need explosive demand to change direction. It simply needs steady, incremental improvements to tip the scales. Another mistake I see people making all the time is talking about Vancouver as though it's one single housing market. It's definitely not. Greater Vancouver is made up of dozens of different municipalities, hundreds of distinct neighborhoods, and multiple property types, each behaving entirely different at any given moment. Broad generalizations wipe out the micro trends that actually matter to buyers and sellers on the ground. When you look at the raw data, the structural divide becomes obvious. Detached homes continue to be the most expensive segment of the market, with benchmark prices sitting around $1.84 million right now. Townhomes remain just over the $1 million mark, coming in at 1.04. Meanwhile, condo apartments continue averaging just under $700,000, hovering roughly at about $695,000. Each of these segments attracts completely different demographics. Detached homes are generally purchased by higher income families or move-up buyers who already have substantial equity to port over. Townhomes often appeal to growing families who desperately need more square footage and a third bedroom, but still require something relatively affordable compared to land-heavy detached lots. Condos and apartments continue attracting first-time buyers, downsizers, and occasionally the real estate investor, although they're on the sidelines right now. That's critical context because these groups don't all react to changing economic conditions or shifts in monetary policy the same way. First-time buyers are extremely sensitive to interest rates because even a small quarter-point change in monthly mortgage payments can determine whether they stress test successfully and qualify for financing or not. And luxury buyers, on the other hand, often care much more about broader investment performance, global stock markets, and general corporate confidence than local mortgage rates. And meanwhile, family moving from a condo, townhome to a detached home is usually influenced by immediate life events like a second child, changing school catchments, or a remote work lifestyle change. Rather than simply trying to time the absolute bottom of the market cycle, this fragmentation is exactly why each property recovers at a completely different pace. For example, in this latest June report, townhomes were the tightest segment with sales to active ratio of 17.8%, while detached homes just scraped into balanced territory at 12. Ultimately, the takeaway from the June data isn't that a massive boom is right around the corner, nor is that a crash is looming. The real story is the quiet return of functional, predictable marketplace for buyers who have been waiting for the dust to settle. And for sellers who have been hesitant to test the waters, this newfound stability offers a reliable foundation to make big life decisions. As we move into the second half of the year, tracking these steady, subtle adjustments will be the key to navigating the Vancouver market successfully. And as always, feel free to reach out if you have any questions about the Vancouver market. I'd be happy to help.